Well, people are struggling, so, I don't think we do today, so. Program income is going to sound like a lot of things we do. But it's income generated directly or indirectly from a grant-supported activity. It's the generic across-the-board OMB definition. So what do we do that generates income? Well, almost everything. We generate fares. By statute, however, Congress has dictated fares must be deducted from total operating cost to yield the net cost of service, and our grant program is formulated on paying 50% of the net cost of service. So typically, even though fares meet the definition of program income, in transit grant circles, fares are fares are fares. They're deducted from total operating costs by law. We don't typically refer to fares as program income. Contract revenues. The local senior center comes to us and says, hey, we're opening a new senior center. Some of our clientele do not drive. We need transit assistance. We'll pay you, $6 a trip to bring the seniors 4 days a week. Get them in the center at 11, take them home at 1:30. They get a hot meal, nutrition program, activities at the senior center, and then you take them home at 2:30, and we'll pay you. Contract revenue. That, again, is a form of program income. And in this case, FTA, because of specific congressional authorization, permits us to use program income as local match. So Congress has stepped in and told us what we can do with it. Otherwise, in the absence of specific revenue objects in our charter accounts, there are typically other things that can happen that we do that will be and will carry the label program income. That 15-passenger Dodge van that we run into the dirt that has 248,000 miles on it, that's 6 years old, it has exceeded the useful life as established by GDOT, and they have granted us permission to sell that vehicle. Anything that we obtain from the sale is considered program income. If we are an urbanized area, we bill FTA electronically, and then they pay us electronically through the ECHO system, and the money goes into our bank account. And then we have some obligations to disperse that money in a relatively short time frame, generally between 3 and 7 days. If we don't disperse that money in 3 to 7 days, FTA yells at us a lot. But while the money sits in our bank account for 3 to 7 days, it earns interest. That's program income. Revenues generated by activities. Sales proceeds are not program income. Interest is not program income. Things that we do that are not transit related that earn income are not program income. I haven't had coffee yet. What is program income? Fees for services performed. So we have a brand new transit maintenance facility built at one of our 5311 projects. They have, because in the planning of that building, they used a 20-year life cycle. So although they only need 3 bays today, there are written plans that in 20 years, that system will need 5 maintenance bays. But in the early operation of that facility, they have some spare capacity, and they agree to perform light maintenance on the sheriff's department's vehicles, and they earn income from that. But the building was built with FTA assistance. The mechanics are in subsidized in part by FTA operating assistance. That is a grant-supported activity that generates income. That income is considered program income. We might have, let's see, there's a human resource agency in just south of, what's the Tennessee, Chattanooga. They've got an FTA-supported building. It's a multi-purpose nonprofit, public nonprofit. They do a lot of weatherization work. They assist elderly people insulate their homes, new windows that are more environmentally friendly and keep out the cold a little better than standard windows. They'll do stuff like that. They keep some construction supplies in a spare bay the transit doesn't currently use. They charge rent for the use of that space. That is program income. We allow advertising on a bus or inside the bus on the advertising racks that sit up above each row of seats. That is income. We don't fabricate things under transit grant agreements. The last one, even though it's in the super circular, doesn't relate to us. So those are program income. Does anybody earn program income or have income from another source that they think may be program income, but haven't broached GDOT on so far? In my experience, most program income is either the lease of space. Maybe we built a downtown intermodal transfer facility, and taxi cabs are allowed to have a stand there, and maybe Greyhound or intercity carrier will station an agent there part-time, and they'll pay for some office space. That is program income. Advertising revenues, program income, and the lease of space, program income. That's primarily what we've done. Michelle?
Rich, I was going to add that anything, any income derived from incidental use of a federal asset, purchase of services is a different issue, but FTA requires our subrecipients to complete that incidental use form whenever they are generating program income. So that needs to be the PTSs need to know, or your transit planner, and you need to get that incidental use agreement on file.
Okay, Miss Can of Worms.
Yeah, sorry.
I'm sitting here in the audience, and maybe I'm unsure what in the world do you mean by incidental use of equipment?
That's what we're talking about. This is just a different name that we call it, I guess. Incidental use, like we have the Macon terminal in Bibb County. They do weddings and things of that nature in the building, and so they have an incidental use agreement.
Okay, that's really short-term lease of space, right?
Yeah, they have to return the program income, reinvest it.
It's not a short-term lease.
This wedding? I've actually
Well,
never-
no, they lease multiple offices to the city
Oh.
for office space, and
Yeah.
those will be there.
That's program income.
Yes.
Yeah, typically, if we're gonna design a building, we know a building typically will have a 40-year life. And at a minimum, for planning purposes, we typically will wanna project our needs out at least 20 years. And so, in the initial years of operation of that new building, it may contain space that we currently do not need, but are projected to need in the future. And that gives us some opportunity to generate program income in the early years of that facility. I'm hesitant to call that type of thing incidental use because incidental use typically is exclusively used in relation to vehicles. And the dreaded C word, charter, is typically considered an incidental use. If if you can comply with 49 CFR Part 604, there are certain instances where you can use your publicly financed vehicles and personnel to operate what otherwise would be considered a charter service, and that is typically classified as incidental use of project equipment. And to the extent you do in fact meet the exemptions or exceptions in 49 CFR Part 604, you can do that. You have to report that incidental use on a per incident basis. You normally file that report quarterly with the state DOT or semi-annually with the state DOT. Incidental use has to be deducted when computing total useful life. So if you have a vehicle that's a 100,000 mile, 4-year vehicle, and you ran the vehicle 4,000 miles in incidental use, GDOT would apply a standard of 104,000 miles in evaluating whether or not that vehicle had met its useful life. So lease of space, typically just as lease of space, it is incidental use, I suppose, but we normally, in transit language, keep incidental use associated with vehicles. But yes, if we lease space, it's program income. If we charter, I don't even want to get into this topic, but if we charter, charter is not an allowable activity from a financial perspective under any FTA program. So when you do an otherwise legal charter, you have to ensure that you're making money on the service, because any deficit that arises from your provision of an otherwise legal charter cannot be paid for out of FTA operating assistance. So you need to have a cost allocation plan in place to satisfy the auditor that when you did that tour for the county commissioners out to the industrial park 6 months ago, and you used the system vehicle, you got to make sure that you made money on the situation. Because you can't charge the deficit to 5311. So program income. Income generated from a grant-supported activity. OMB says there are 3 methods or treatments of program income. There's the deduction method, which is comparable to the way we treat fares. We just simply take that program income, we deduct it from total operating costs. It reduces the federal, reduces the local share. That's generally the method most federal grant programs prefer. With grantor agency approval, you could add the program income to total project costs. That's rarely used, in my opinion. That's the addition method. And then number 4 is the program match method. With prior approval of GDOT, program income can be used as local match. FTA in 5010, the Grant Award and Management Circular, says we've looked at these 3 options and we will let FTA recipients under all programs use program income as local match, provided it is not used as match against the grant from which it was earned. So if we're using our FY19 grant to pay for utilities in our building, and we run those utilities and we run the building and we lease out space during FY19 to Hudson News in our intermodal facility, any income from that lease we can keep, we bank, and we can use it to meet the local matching share. Our FY19 revenue can be used to meet FY20 operating expenses. We cannot use it in the year in which it was earned. So FTA is a little different than most federal grantor agencies that will elect option 3 from the 3 allowed uses of program income. So you need to be aware of that. Does anybody earn program income here? Take the question.
I'm a little confused. It has to be, it cannot be used in the year it was earned.
And the grant, yeah, and actually the language is, it can't be used to match the grant from which the income was earned.
So if I have a contract with the senior center, like you used the example, I have to bank that income and count it as match the following year.
No, that's contract revenue. We said yesterday, and I emphasized this, contract revenue can be used as match in the year in which it was earned. FTA adds that sentence to the contract revenue discussion in Chapter 3 of 9040 to distinguish its policies on contract revenue versus program income.
So income from like advertising,
Has to be used in another year.
What about excess purchase of service rate?
FTA does not address
Well,
the
do I know?
situation where what happens if your local match requirement in a year is $350,000. It just so happens that you're pretty aggressive, your local area is very pro-coordination, and you have contracts that result in contract revenue from the provision of service under contract to human service agencies of $360,000 in that year. So in essence, you can use your contract revenue to meet 100% of the local matching share, $350,000, and you've got $10,000 left over. FTA regulations in 9040 do not address that scenario. So then it's left up to individual grant managers or program managers to determine how to treat that. I believe that the proper treatment of that excess contract revenue is to treat it as program income, allow the system to bank the revenue and to use the revenue in a future grant year as local match. But that's just the world according to Rich, and I have no weight.
Hey, Rich, if that $350,000 came from 5310,
Yeah, then it can't be used as match. Then essentially, yeah, since you could never use 5310 to match 5311, then it sounds to me like she got over program 5310 funds.
Now, within the contract revenues, it's a very small bit of 5310 that so they know not to match that, use that as local match, so, but it's a lot of other funds that come down through the state.
Yeah, after yesterday's discussion, I'm thinking that a conversation needs to be had with FTA in Washington about excess local match. I can tell you what's happening now. Whether or not that's the proper treatment is debatable. I know that in one situation, someone has interpreted excess local match as needing to be used in the deduction method. And that's one interpretation. But I think given the history that FTA has had in looking at these options and always selecting typically the option that's most favorable to the subrecipient, it is my belief that if directly asked the question, FTA would say, that they would permit you to keep the revenue, bank it, and spend it in another year on transportation.
But it has to be used on transportation.
Yeah, they would definitely say you could, at the end of the year, call it a fund balance and go migrate it over to general administration to pay for the salary of the executive director. They would never let that happen. But again, I've never seen nary a word in writing from FTA on that scenario, and I just don't think FTA has weighed in on that.
If it was banked or kept back for a year or whatever, would it have to be accounted for or documented?
Yeah, absolutely. I think that, verifiable from the subrecipient's accounting records would be instrumental in the decision to allow it to be used in the cost sharing or matching category. I think that goes without saying. That would be an automatic assumption that we would have to make.
Does it stay at the local level or go back to the state?
Now, I think that FTA would probably say, as long as you're willing to use it for transit, that, yeah, we don't want to give it back to the state. You can keep it at the local level, spend it on improvements of transit service next year. Yeah, in particular for nonprofits. I mean, in essence, the only way a nonprofit dealing with transit is ever going to create a fund balance is they've got to develop pricing mechanisms on their contract rates that allow for some modest accrual of revenues over expenses, or they'd be out of business. There'd be no fund balance. We don't use the term profit in public transit, but essentially that's what's happening. We're setting rates that will enable us to accumulate a modest fund balance. I don't think the buyer of the service expects to have money returned at the end of the year. They've agreed to a unit rate of reimbursement for that contract. If they've done their due diligence, they're happy with that unit rate. They're satisfied that that represents market conditions and the like.
But if they are showing a fund balance, or as years go on, you see it growing, then it may be their unit cost is too high.
That's a distinct possibility.
And that you can adjust if that.
Yeah, if I was a buyer of service and I saw that fund growing exponentially, yeah, I'd probably get out my pencil, sharpen it a little bit. When I went to sit down with them and negotiate my rate for a forthcoming year, I'd probably be a little more hard-nosed in the negotiation. But most nonprofits are pretty transparent about these things, and quite frankly, it just, between disallowances of Medicaid trips that you've delivered, and then you find out 45 days later that Mary lost her eligibility on Monday, but Medicaid the broker told you to transport on Tuesday, you took the broker's word for it, well, you've lost all that money, and you have no recourse. You're just flat out on the hook for the cost of that trip. That's basically what you're going to use most of that fund balance for, to cover unrecoverable service delivery. So no one's going to get rich or accrue fund balance that's going to be out of the realm of reasonableness. Michelle?
I was just going to say, in that scenario, it sounds then like if we're making up with contract revenues for lost income that occurred under the Medicaid, it sounds like FDA then is subsidizing the Medicaid to me. That's just
Medicaid would argue vehemently. Medicaid believes, erroneously, I might add, that they subsidize public transportation. And they have not one shred of evidence to support that position, but it's articulated in the brokerage rulemaking back from the Deficit Reduction Act in 2005. They've actually articulated that statement in the Federal Register. It's the most nonsensical statement I've ever seen coming from a federal agency, predicated on nonsense. It's just absurd. Public transit subsidized Medicaid to no end, and they don't realize it. And I don't know why they continue to maintain that position over the years. But that's a story for another day.
I keep jumping in, and Nancy, just correct me if I'm misstating, but I don't think GDOT's opposed to, them, for financial capacity reasons, we'd like to have like a 90-day buffer. And so I think the excess purchase service would be carried over and reinvested. Is that?
Yeah, North Carolina, when they do compliance reviews, they actually look at the rainy day fund of the nonprofit organizations, and they want to see 90 days. Yet, it's very difficult to create that kind of fund balance without substantial fundraising activities for a nonprofit organization. And fundraising, typically, those activities, those revenues are restricted because the donors place restrictions on the fundraising activity. So again, what we've been speaking about here, when contract revenues, if you're lucky enough to have contract revenues actually exceed the local matching requirement, which is different from the example that I showed yesterday at closing time, there is no written guidance from FTA that's ever been promulgated about the proper treatment of that revenue. So it's left, quite frankly, to the state DOT to determine how to best use that revenue. I like to believe that FTA can be fairly benevolent, and that if asked the question, they would probably render a decision that was favorable to the local transit provider. Meaning you would get to keep that revenue and not use the deduction method, which would end up lowering your federal share of FTA money. I think it could have negative cascading effects, and therefore not only is this perhaps the most pro-transit answer to the question is permit an agency to use it as cost sharing or matching, but to restrict that to the transit account of the organization, and that it must be verifiable from the accounting records of the agency.
Okay, but Rich, back.
But that's my personal opinion, and my opinion means nothing to GDOT or FTA. Just please remember that.
Backing into what you
I'm not speaking on behalf of the state.
backing into what you just said, at some point down the road, it will have an impact on their request of 50% federal share.
Yeah.
Or 80%, whether it's capital operating, you're going to decrease a future request for federal funds because you're gonna fall back and use that excess purchase of service.
Yeah,
Or
I mean,
whatever you wanna call it.
exactly, and obviously other things that a state has to look at is 5311 is designed to fund rural public service. It's not to provide management services of a coordinated human services system. That is an allowable activity, but that's not the primary purpose of 5311. It's to support public transportation of non-urbanized area residents. At some point, systems that are accumulating a lot of balance in the contract revenue account, it would probably behoove the state to look at just how open to the public they are. And am I funding human service agency transportation, or am I funding rural public transit? And that's a factor that would be taken into account in each grant application cycle.
You bring up a very good point with that. If you have a lot of excess purchase service, we know in the state of Georgia about 76% of our trips provided on our public rural systems are human service contract revenue trips, which leaves about 26% public trips. So a good solution for excess purchase service in my mind is there's a whole element of public that are not being served. Use the excess purchase service to expand your service to the public.
Right. And this has been a debate for the ages. In many respects, rural transit's origins, or the genesis of a program, is that the rural public transit system grows out of some level of coordinated human services and then expands to take on the general public. And that's essentially the model we developed in North Carolina, we're currently about 66% of the ridership is human services. From about 18 key sources, Medicaid constitutes 20% of all ridership on rural public transit in North Carolina, and about 17 other sources make up the other 40%. Over time, as systems mature, more and more public ridership accrues. It's a slow growth curve, but it is a growth curve nevertheless. That's kind of what we want to promote. So we kind of don't want to, throw the baby out with the bathwater by being too strict on coordinating services with human service agencies, because it's an important revenue stream for the organizations. And in some rural counties, there just simply isn't the population base that could support a rural public transit system unless it was coordinated with human services transportation. And so I think the policymakers have to strike a balance in their management of 5311 in that activity. Any state takes a different approach. At one point in time, Virginia attempted to mandate that X% of your ridership had to be GP. And then we get into counting issues. If they're a client of the senior center, but the senior center isn't paying for their trip, but they are over 65, which bucket do we count that trip? Is it a general public trip? Is it a senior center trip? That we get into this Florida model where we basically count sponsored and non-sponsored people. That can overly make the situation more complex than it needs to be. I think we got to remember we're in the mobility business. And if we can get somebody else to pay for the trip, the system's stronger financially for it, and it benefits the provision of rural public transit. And as rural public transit matures at each county level, over time, the rural public ridership grows. As we're seeing a decline in the funding of most human service agency programs, those 52 non-FTA programs that GAO identified in 2002, we're seeing a decided personal choice of consumers to ride as a rural public patron on public transit. And public transit is going up, if for no other reason, human service agency funding is going down. And so that provides a vital link to those citizens who can't drive, can't afford to drive, or have a disability that prevents them from driving. And it makes them live in the community longer, more independent living options. And so I think there are a lot of public policy benefits for understanding that rural transit and human service transit are like peanut butter and jelly. They go together between the two slices of bread, in my mind. So again, here I think is the key to my philosophy on what to do with that excess revenue, is that grantees can retain program income so long it is retained restricted for program purposes, and it be dedicated to future capital and operating expenses. And then here is the language quoted verbatim out of FTA Circular 5010. It said, program may not be used to reduce the local share of the grant from which it was earned, but may be used in future grants.
Rich, I just wanted to talk about semantics just for a minute, because I think that GDOT, we've been calling everything contract revenues, program income, and you bring up the new word contract revenues, and I kind of like it. I think Nancy probably likes it too, but I never had that distinction made before. This is the first time. We were thinking program income was contract revenues, I think, or calling it the same thing. Does that make sense?
Yeah, I mean, if I'm an accountant, I'm looking at contract revenue, and my CPA brain says that's program income. But because there are specific congressionally authorized uses of that type of revenue, I try to refer to it not as program income, but to keep it under that little separate category that Congress gave all FTA programs. And so I call it contract revenue. And I believe that's probably the more accurate description of that revenue, because Congress also gives us the authority to use it in the year in which it was earned. So I see a distinction between program income, that is contract revenue, from other types of program income that FTA recognizes, which is the sale of advertising, provision of incidental services, etc. That's just my own personal philosophy.
Okay, so just to be clear on what I'm hearing here, what I understand is the FDA has a policy and procedure for treating program income. They do not have a procedure on treating contract revenue.
No, they have a procedure, but what we've been discussing this morning is sort of a scenario under the existing policy that creates a dilemma.
Exactly, we're a for-profit provider. We operate 17 systems. And, you know, we depend on this program income or a contract revenue to sustain our operations.
Now, the super circular, which is what we've been talking about, does not apply to for-profit entities. You mentioned yesterday you'd be subject, and if I have a contract with
That's
you,
sub-recipients, does it not?
yeah, it does apply to subrecipients. And there are instances where for-profit entities act as subrecipients, most notably in the 5311F program. But when I enter into a contract with you and you serve in the role of contractor, I'm not applying super circular rules to the governance or the financial management of that contract. I'm applying federal acquisition rules. And in those rules, you are allowed, and even in super circular rules, when I enter into a contract with a third-party for-profit operator, profit is an eligible use of funds. And depending on the type of contract, I can get guidance from various aspects of federal law that determine what profit I should negotiate with you. Profit is a negotiable item. And in some instances, profit is capped at 10% under certain contracts. The more risk you undertake as a contractor, supposedly me as the buyer should be willing to fork up a little more in profit. And if I accept unit pricing, and that pricing was bid assuming a 12% profit margin, but you introduce efficiencies in the execution of that contract and you end up making 14% profit, you get to keep that. That's your money.
So you have that language in your contract, your TPO agreement with the counties in which you operate your systems, or that stipulates that all risk from operating that system will be on TPO's shoulders, as far as operating income and expenses.
Well, you could structure a contract like that.
So all revenue, all profit, all losses are the TPO's.
Exactly.
Okay, so we make excess POS because we're aggressive. We're out trying to do a true coordinated system at ground level, and we're successful in doing that, and we're running an efficient operation. Then we have to put back our reward for running a good company.
Yeah, the typical procurement scenario is that a buyer of service puts out an RFP, he needs a contractor to come in and operate the service. In the terms, the technical specifications of the RFP or IFB, that buyer will typically spell out, you should anticipate so many revenue hours of service and so many revenue miles of service to operate what we plan to do in FY20. You've got to take my word for it, because if actual hours and miles of service come in greater than 10% less than what I put in that RFP, you're likely to lose your shirt on that contract. If actual revenue hours or miles come in over that amount, and on a unit pricing basis, you're likely to make more money than you anticipated on that contract. My experience is the private sector, guys in your shoes, don't trust the public sector one iota when they put a number in the RFP that says, here's the number of hours and miles that you're gonna operate. They don't believe that number.
Well, what would happen if you got an agreed upon unit price, your grants for X number of dollars? And
Yeah, typically,
what do you do? Because you only got a limited amount of money.
yeah, typically what a contract and the RFP should stipulate is we are looking for prospective bidders to submit a bid based on revenue hours of service. In order for us to properly evaluate vendor A from vendor B from vendor C, we want you to base your bid on 60,000 annual revenue hours. And then we will enter into a contract and pay you X amount per revenue hour. Up to a maximum not to exceed $1 million. And that's the term of the contract, and you've got to decide whether or not, given your cost structure, whether or not you can deliver that service, meet that number of hours for under $1 million. That's a decision you guys make when you're considering submitting a bid or not on the project. So you've got to live within that $1 million lot, but if you bid 60 an hour, you can live with the $1 million and you can make more than 10%, then you make more than 10%.
But in that scenario, you would be maxing out at $1 million. But then you would not, if they don't produce the trips, and you're going to lose.
You're going to lose money.
So you're going to be protected, you know, or you're going to be maxing out on how much you can make, but not on how much you can lose.
Right.
But Rich is talking about an hourly scenario versus a per trip rate. So that might help a little bit.
Well, I know that you got variables that you can throw in there.
Yeah.
And that's risk that the contractor typically bears. If I'm inaccurate, you're bearing the risk, not me, because I'm just paying you $60 an hour per revenue hour. And I have to assess that as the buyer, is how much risk am I taking off the local agency's shoulders and putting on your shoulders, because that affects the profit margin. The more risk I put on your shoulders, technically the higher profit I should permit. All right, so just a couple of rules. Generally, we in transit, even though our accountants may look at fares as program income, and that would be a technically correct interpretation, we basically never refer to fares as program income, as they are mandated by Congress, automatically be used in a deduction method, whereas program income is treated in the local match method. Revenues derived from provision of service under contract, again, I believe, since we're allowed to use that revenue in the year in which it was earned, I like the separate title to contract revenue to distinguish it from program income, which I know from an accounting standpoint has to be banked and used as local match in the future year. And all of it must be verifiable. To get back to DHS's point, all has to be monitored and verified in the audit process.